Welcome to the Finance and Accounting module of the Youwin Connect program. The objectives of this module is to help you, first of all, identify the functions of accounting information in the decision-making process. Next is to help you explain the elements of financial statements, followed by identifying different types of cost in a business. Also help you identify and define what cost control really means, and lastly, help you create cost consciousness in an enterprise. This module is broken down into 3 major sections: using and analyzing financial statements, section 1, controlling costs, section 2, working with budgets, section 3. Using and analyzing financial statements, section 1. This section is broken down into sub-sessions. The first session we are going to look at is the role of accounting in decision-making process. Accounting information and decision-making process. To make informed decisions, accounting information is very important. We are looking at 3 major types of decisions in accounting. Number 1, business decisions. Number 2, investing decisions. Number 3, financial decisions. Business decisions are the day-to-day decisions you make for the operations of the business, while investing decisions are decisions you make that helps you to expand the capacity or the production of the business or the earnings of the business. Lastly, financial decisions are decisions that has to do with funding of your operations. Should we borrow? Should we get more equity players? All these decisions have to be made based on accounting information. Accounting information is an important source of financial information in the management information system. Accounting information plays a key role in formulating the financial information provided to information users. We are going to look at the classifications of accounting information. Accounting information is classified into 2 major groups. The first group is financial accounting information. The second group is management accounting information. Financial accounting information is designed to support management and other external users like investors and lenders in their decision-making related to the allocation of resources, investment, and credit. While management accounting information is designed to support management in their business operations, managers use this information to identify targets, devise plans, manage daily business operations. The primary difference between financial accounting information and management accounting information is that management accounting information is customized and designed by management to suit their daily needs to make business decisions, while financial accounting information is required by law and has standards on how they are to be prepared. This takes us to the next session, which is the elements of financial statements. Financial statements are reports that gives us information about what is happening in a business. For the purpose of this module, we are going to look at 3 major financial statements. The first one is the balance sheet, also known as the statement of financial position. The second one is the income statement, and the third one is the statement of cash flow. Let's look at the balance sheet. The balance sheet is a report that reflects the overall picture of existing assets in the company and its financing sources as at a specific date. The balance sheet as a report gives us all the assets that the company owns as at a specific date and how these assets are funded. So you always usually see assets equal to the total liability and total owner's equity in a balance sheet. It is also referred to as the value of a business as at a specific date. An example of a balance sheet is the exercise we are looking at where Philip opened a photocopying shop on the 1st of of July 2005. The assets of the shop include a brand new photocopier valued at 25 million naira and 5 million naira in cash. To acquire these assets, Philip borrowed 20 million naira from his family and the rest come from his savings. The total assets that Philip has is the photocopier, which is 25 million, and cash of 5 million. The total comes to 30 million. 20 million is funded by the loan from his family, while the 10 million is funded by his own funds, which we call owner's equity. So what do we mean by assets when we say the balance sheet is made up of assets, liability, and owner's equity? Assets are the resources managed by the company that can produce future benefits. The asset must fulfill three major conditions before it can be referred to as an asset. Number one, it must have economic benefit. The asset must have a price that it can be reasonably determined by, and it must have an original price. The assets are what the company owns and it uses to produce economic benefit. We are going to look at assets under two major categories: short-term assets and long-term assets. Short-term assets are assets that have a lifespan of 12 months or less. Examples include the cash you have in hand. They always change in value almost every day. Short-term investment, like call deposit or a fixed deposit. Accounts receivable, which also means the same thing as your customers you have sold to and are still owing you. Inventory also means the same thing as stock. This could be your raw materials, your finished goods, or work in progress. We have the second category of assets referred to as long-term assets or non-current assets. These are assets that you have and they are there for over 12 months. Examples include building, land, real estate investment, or other long-term investments that expand beyond 12 months. Let's look at the next component of the balance sheet, referred to as liabilities. Liabilities are the current obligations that derive from past transactions that are paid from resources. Examples of liabilities include accounts payable, which means the amount you owe your suppliers for goods they have supplied you have not paid for. Another example are accruals, which represent expenses you have enjoyed or incurred but you have not paid for. For example, the electricity bill that you have not paid for, or salaries that the business has incurred but not paid for. Whatever is owed by the business is referred to as a liability. A good one is a loan you collect from the bank. Let's look at the two major categories of liabilities. We have current liabilities and non-current liabilities. Current liabilities are the obligations you need to fulfill within 12 months or less. Examples of current liabilities are short-term borrowings, accounts payable, which means the same thing as your trade creditors, suppliers who you have collected goods from but you are yet to pay, while non-current liabilities are obligations you need to fulfill over 12 months. For example, a long-term loan, a loan that you need to pay back over a period of 2 years, 3 years, 5 years. Those are examples of non-current liabilities. Let's look at the last item in the balance sheet, owner's equity. Owner's equity is the shareholder's own capital value. This is represented by two major components in the balance sheet. The first is the capital contributed by the owners of the business and sometimes investors. The second component is referred to as the retained earnings or retained profit in the business. Retained earnings or retained profit is the profit that is plowed back into the business, while contributed capital represents the amount of money injected into the business by the owner or the owners of the business. We have covered the three major components of the balance sheet: assets, liabilities, and owner's equity. This takes us to the next financial statement, which is the income statement. The income statement shows three major components: revenue, expenses, and the net loss or profit of the company during a specific period of time. The income statement is a report that tells you the performance of a business over a period of time. A period could be a month, could be a quarter, it could be half year or 1 year. It covers a period. Let's look at the three components of the income statement. The first component I mentioned earlier was revenue. Revenue is the income received or to be received from the sale of goods or services. Revenue in the income statement is not cash. Once an item has been sold, whether for cash or for credit, it is recognized in the income statement as revenue. In a situation where your business renders services, once services or service has been rendered, it is recognized in the income statement for that period as revenue. This is what we refer to as the accrual principle. Looking further at revenue. Revenue can come from not only the sales of your product or services, but can also be generated from financial activities. Let's take a look at the next component of the income statement, referred to as expenses. Expenses are the total of cost of goods sold, selling expenses, and general and administrative expenses. Please note, expenses do not include your VAT. They are primarily the cost incurred by the business to generate the revenue that is recognized within the same period. Let's take a look at examples of expenses. We have operating expenses, which includes your selling expenses, general and administrative expenses, your cost of goods sold. We also have financial expenses, which includes borrowing interest, exchange loss that you might incur during the operations of a business. Depending on your type of business, whatever expense you incur can fall into any of these categories. Let's now look at the last component of the income statement, which we refer to as profit. Profit is derived from the difference between revenue and expenses. You have a profit when the revenue generated is more than the expenses incurred, while you have a loss when the expenses incurred is more than the revenue generated. When you deduct all your expenses that you have incurred over a period of time from the revenue you have generated during this same period of time, whatever you have left with is either a profit or a loss. A profit when revenue exceeds expenses, a loss when expenses exceed revenue. We have looked at the three major components of the income statement: the revenue, the expenses, and the profit. This leads us to the last financial statement we are going to discuss, which is called the cash flow statement. The cash flow statement is a report that tells you about the movement of cash in and out of a business over a certain period of time. The net cash flow position as at a specific date is the difference between the total cash that came in over a period less the total cash that went out. So the total cash that comes in is referred to as cash inflow, while the total cash that was spent is referred to as cash outflow. The cash flow statement recognizes the flow of cash under three major categories. The first category is referred to as cash flows from operating activities. This represents cash that comes in from revenue, less cash that goes out from expenses. The second category is cash flow from investing activities. This represents cash that comes in from sales of an old machine, an old car, and cash that was spent on purchase of fixed assets like a machine or investment. The last category is cash flow from financing activities. Cash can come in from lending, cash can come in from additional investors bringing in capital into the business, while cash can go out by repayment of loans or paying back dividend to investors. Those are the three major operating activities: investing activities, financing activities. These are the three activities that define the movement of cash in and out of a business, of